Corporate finance practice problem using OneNote. Stock repurchase versus cash dividend. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 1831 Stock Repurchase versus Cash Dividend tab. Also note, when using OneNote, look at the immersive reader. Our presentations will also be in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations then on down below, looking at the comparison of, imagining that we have excess cash and we're going to think about either a repurchase of our own stock from the market, or to take that excess cash and be giving it to the owners in the form of dividends. We will then consider what the price or the effect then would be on a particular owner of the corporation between the two situations, either the repurchase situation or taking that money and giving it back to the owners in the form of dividends. So our information is, we have the earnings. That's going to be like the bottom line of the income statement in essence, which is net income of the 5 million. We got the shares outstanding. So that's how many units of shares that are out there, 2 million. The price earnings ratio, we're going to say, is at 30, and the excess cash, which we are considering either using to repurchase our own stock back or to be giving in the form of cash dividends, is 5 million. Let's look at our earnings per share calculation. So the earnings per share can take the 5 million, that's our earnings, bottom line of the income statement, and the outstanding shares of the 2 million. The 5 million divided by the 2 million would give us 2.5. The EPS, the earnings per share, 2.5. That is also down here just so we can see it when we go to our next calculation, which is going to be the calculation of the stock price. So the stock price, then, we're going to be using the price earnings ratio to calculate. You may first think about the price earnings ratio to back into the price, because the price earnings ratio is fairly self-explanatory, comparing the price to the earnings, noting that when we think about earnings here, we're not thinking about aggregate earnings, we're thinking about the earnings per share, which we just calculated. And then you can kind of back into the unknown, which would be the price, which is what we'll calculate here. So we're just going to calculate the price, reformatting the price earnings ratio to solve for price. And that's going to be the price earnings ratio of the 30 and the earnings per share of the 2.5 that we calculated up top. That then giving us a stock price of the 75. All right, first we're going to imagine then, so this is going to be our stock price at this point in time. Let's imagine we take then that 5 million excess cash and we give it out in the form of dividends. How many dividends would we be giving out per share? Dividend per share. We got the 5 million that we're going to imagine that's the excess cash we're deciding about as to whether they should be going out in dividends or we're going to give it out or purchase our own stock back. This time dividends paid out, 5 million. To the shareholders. There's 2 million of the shareholders. That means the dividends per share is going to be 5 divided by the 2, which is the 2.5. The 2.5. Then we're going to say, well, how many shares could we acquire if instead we took that 5 million and acquired the shares? So if we reacquire these shares, we're going to take that excess cash of the 5 million and the stock price of the $75, imagining we can buy them back at the 75. And that's the 75 we calculated up here. We're imagining to be the stock price. So how many shares could we then buy? Well, we got the 5 million divided by the 75. $5 million. That's not a 5. My fingers are on the wrong keys. 5 million divided by 75 is the 66666.66666, or this number about. Obviously, we're dealing with rounding here as we're talking about a number of shares. So we got to deal with rounding involved. We've got then the earnings per share calculation at the 5 million. And then we got the number of shares that are outstanding at this point, which would be the original number of shares, the 2 million. But then we're imagining now that we repurchased this number of shares. So we have that many less shares. So in other words, we've got the 2 million minus the amount we purchased back, 0.67 about. So we have then about that many shares. So if we take then the 5 million divided by the number of shares we would have outstanding after having taken our excess money and repurchased the shares that we could with it. Then we have about 2.59 of the earnings per share. It has now, of course, changed from the earnings per share in our previous calculation. What about the stock price then? We're going to assume that the repurchase didn't affect the price earnings ratio. Price earnings ratio then remaining at the $30. So we got the PE ratio at the 30, the new earnings per share at the 2.59. So that's going to give us our 77.59. So the change to the stock price went from 75 to the 77.59. So that would be the increase due to us basically purchasing back, the shares off the market. So now we're going to consider then what would be the impact to a shareholder if they owned simply one share before and after or under the two scenarios. So a stockholder with the dividend, let's assume the scenario 1 where we gave the dividend out. Well, we would presume the stock price of the 75, the price we started out with, and they would get a dividend, which would be in the form of cash. It wouldn't increase the value of the stock, but they'd have then cash of the 2.5, so their assets related to the company would be stock value and cash, 75 and 2.5 for the 77.50. If we then look at the stockholder assets after we reacquired, meaning we didn't pay the dividend out, they wouldn't get the $2.50 per share of the dividend, but rather we took that money and had a repurchase, then we would expect the price of the stock to go up, all else equal, and we calculated that under this scenario to be 77.59. So you can see they're in a comparable spot generally under the two scenarios, although the distribution will change in terms of, how that, what it's consisting of. If we give the dividend out, then of course the shareholders would have the cash dividend and the value of the stock, but they wouldn't have. And then if we did the repurchase process, we should reflect a change, you would think, to the price of the stock and result in somewhat of a similar situation. Of course, it will also depend on the market. So whenever we're considering the actual price, we're thinking about the market. The market could interpret these different actions differently and result to that, differently depending on how they perceive the actions being taken by the corporation.